Welcome to forextrading.com. Let's talk about splitting the positions. There are a lot of times when you are entering the market, when you are not really sure what the profit you will be taking from market or what kind of stop loss profit to set at the beginning when you're already in the market. Well, it is very necessary to understand that most of the time, whenever you're trading with intuition or you're trading with technical analysis and other instruments, most often there will be time where when you are not 100% sure, whenever these positions would be closed or open, or you keep it for a while, just to make it a point, you're never going to be 100% sure. If you are, that's great, but these are the moments that are really kind of bonus that goes with time. So it is really important to understand to level this hesitation level down a bit because it is really necessary to do all the decisions with some kind of plan. And we are going to talk about splitting the positions. Right now we are watching a 30-minute dollar chart, and we gonna show it to you at the example what I'm gonna talk about. Well, let's say you're seeing here the trend is moving up. There are not too many sellers, important strong sellers not coming into the market, and you see those buyers are coming in more often and more strongly. What is most important? And you will be seeing like this situation here. We got this big triangle, and you're feeling like this is the best moment of coming into the market, and in this direction you will be probably right. So whenever you're trading at 5-minute charts, 30-minute, or you are a daily chart trader, you will be seeing this chart which might looks exactly the same like this one. So when you're entering the market, let's say in this moment when the signal is breaking up from some point, and you know this is the best moment to get into the market, you're opening positions. Let's say you wish to split some profit in the future because you're not sure how much long the market's gonna last in the uptrend, whenever it's gonna be 100 pips or just 50 pips. I got idea how to make sure that you will be on top whatever will happen. I mean, whatever will happen, unless the market goes opposite way right after you entered. The first thing we need to know that in order to profit from the market, the direction is necessary. The right direction you choose is necessary. But then many things can happen. You might even fall down with your stop loss, or make it even. I mean, no profit from the market even after the point we moved in right direction, but the markets came back after some time. So the idea is to buy, let's say you're trading just a small position, you're buying couple of contracts, I mean two exactly contracts. To try this, you must be able to buy at least two micro, or the smallest kind of contract you have possible with your broker. So you're buying, let's say for example, you're buying, to keep it simple, you're buying two contracts right here, but you're not sure, you almost never sure when the market is gonna stop or when the market is gonna fall down again. I mean, there is a probability involved, but let's say you're never 100% sure. Let's keep it like this for this example. And you're entering market here with a couple of contracts. So the idea of splitting the profit is, if you are a day trader, especially when you're day trader, you probably know that the market of euro dollar currency will move not more significantly than 200 or 300 pips per day. Most likely, the regular average move of this currency will be 150 points right now. As you can see, this strong move here was 155 pips with let's say average move for this day was, let's say, from here it was 190 pips for whole 24-hour cycle. So what I'm trying to say, there's probability involved, and you might say you wish to take profit from your position after one day or a few hours of trading when you already make a profit and you're not sure how far this trend's gonna go up. So it is very often necessary that if you have a bigger positions or you afford to buy twice bigger position than you initially think, or you have good kind of idea that double position will be exactly good for you in this moment. It is possible, you know about this, to you can get rid of one of contracts bought before in the moment when the market is swinging back in the worst direction you think of. So what I'm trying to say, part of the profit you can take, let's say, those 100 pips when you're feeling the market is slowing down for the day and you're not sure what is going to happen because a lot of data, a lot of publication information is coming up in the later afternoon or evening or next day, and you're not sure if some corrective wave will fall down and make this trade even when it's gonna be the price action will be in at this level. So you're not sure if you want to risk with the stop loss you took at the beginning. First of all, you move the stop loss at the break-even point. So the worst possible scenario is that you will not broke on this trade. You will be even, so you're not gonna profit. You're not gonna lose anything. So this is the worst scenario. The best would be you take the half of the position with profit right here, or when the markets start to falling down, like in this for example particular moment, or you feel the market already crossed some support resistance and there is not much chance it's gonna move higher. Because let's say this move for the day, if you're a day trader, you already probably know that this kind of move, let's say it's a one big move for 150 pips. It's not too often the market's gonna go much higher from this point. So crossing the support resistance, it was a good idea of taking half of the profit or part of the profit for the day, and that's how it looks like. So if you let the other part of the position, the other contracts in this example, the other contracts will run, you might have the chance to take another profit from this move, because if you look at the 4-hour chart, you see this might be a continuation pattern after this strong move. So market can really range a little bit in at this level, and it can break through the upper support resistance and go aggressively high. So it is necessary to know both ways the market can go. It can also fall down a little bit. A little bit means it will be falling down just a bit from the support resistance, and it can stop right here. It can stop exactly at this point when you have this break even point with your stop loss of the second contract we've let it run for some time. So in this scenario, the best scenario would be you took profit in this point. It was very fast profit for the day, very nice. So you are happy, and you confirm your skill with the market, which is very important. And you've managed yourself to keep those profits running because the trend is really growing. It is going up. So the more probability is that the price section will show us in next few hours, next couple of days, another tops that it will grow, maybe aggressively. We'll see about this. So the best would be the best scenario is when the another contracts will break through those support resistance, and you will take another profit when the market will slow down for a bit with another support and resistance, like let's say this point, beautiful moment. So you would take another 150 pips, and that's what I'm saying about the profit just from trading couple or 3 days. So you can be you can take those 200, 300 pips from the market movement without necessary coming to the market 3 or 4 couple of times. You can do it one time when there is a good situation, when there is a good hope, when there is a good probability for market to grow. So the worst scenario for this kind of technique with trading would be that you took your profit and the market fell down, and your transaction, your trade is closed with this break-even point, stop loss set on zero profit, not to lose, not the profit from the market, not to take any bigger risk that the market fell down because of the sellers came into the market, like we could see those big candles like here. If we see couple or three, four of them, it might be understandable that the sellers are coming into the market, and you gonna lose on this trade when you keep your stop loss at original point, let's say here, because we entered here into the market, so the stop loss would be somewhere around here in this position. If we are thinking about taking a 150 200 pips from the market, it is necessary to have kind of 30 50 60 pips stop loss to make it sure our chances with market are even, or we have the bigger chances to win than the market take our stop losses. So this is a kind of example of splitting the profit. In another video, you will be watching splitting the entry trade position. It is kind of more complicated. For me, it is most simple, as I can see, to take the profit differently than entering the market with different points, especially that entering market in different points is about medium and long-term trading when you have really developed your patience and time for trading. So you're kind of thinking about 200 and more pips movement with the market. So this what I'm showing to you could be used and at the short time, medium time, long time, whenever you wish. And it is really simple with more advanced techniques about splitting the entry position. We'll be talking more soon. Thank you very much for watching. I hope it was useful, and I hope you